ANZ Research pulls forward its forecast for the first rate cut in Australia to February from May after some softer inflation figures. But the US rates outlook has risen after much stronger jobs growth in December than expected. That widening of relative interest rate expectations has dragged the Aussie dollar down to post-COVID lows as we start the year. That's coming up in our 5 Things in 5 Minutes. And then in our first bonus deep dive interview of the year, ANZ's chief economist for Greater China, Raymond Yeung, explains why China's economy may well achieve its 5% growth target for 2024.
The overall backdrop is that the government is supporting consumption, and there has been a policy, they call it the 2 new policy, to encourage both corporate and household to spend on new equipment and also new devices, including cars.
But first, in 5 and 5 with ANZ, the big news in the global economy to start 2025 was a much stronger than expected jobs growth figure in the United States on Friday night. US non-farm payrolls rose 256,000 in December from November, which was around 100,000 more than expectations. The US 10-year Treasury yield rose 7 basis points to 4.76%, and the 2-year rose 11 to 4.38%. That saw the S&P 500 close on Friday down 1.5% as futures markets pushed out the expected timing of the next rate cut by the Fed to September from June, with the chances of a second cut this year reducing to 20% from 60%. ANZ Group Chief Economist Richard Yetsinger saw the jobs result as consistent with that slower pace of Fed easing.
I think payroll's largely still in the Goldilocks frame, but probably verging on a little bit too warm rather than a little bit too cold. And markets obviously have backed off progressively over the last couple of months from the idea that the Fed would keep easing at every meeting. And that's been consistent with our view. We expect the pace of Fed easing this year to slow materially from what we saw through the second half of 2024.
As of 4 a.m. Sydney Melbourne time, with all this talk of high US interest rates for longer and possibly an earlier Australian rate cut, more on that in a moment, the Aussie dollar begins the new year at 61.45 US cents. That's the lowest point since COVID. The Kiwi dollar begins the year at 55.56 US cents, its lowest point since September 2022. Number 2, ANZ Research has changed its call for the next cash rate change by the Reserve Bank of Australia. ANZ Australia senior economist Catherine Birch explains why ANZ now sees a rate cut in February rather than May. It's all about lower expectations for inflation after weak figures for November last week.
The main reason we pulled forward our rate cut expectation to February was because we did downgrade our forecast for the Q4 trimmed mean inflation. Previously, we thought that it would come in largely in line with the RBA's forecast of 3.4% over the year, but we have downgraded it by 0.2 percentage points to 3.2%. And quite a bit of that is also reflecting a downgrade in some of the services inflation as well, which is also something that the RBA has been concerned about. Now, we can't write off a hold by the RBA at the February meeting, particularly because there is still a bit of resilience in the labour market. So job vacancies rose by 4.2% over the quarter in Q4, which was the first rise since mid-2022, and the unemployment rate fell to 3.9% in November. But there is growing evidence that actually inflation can be consistent with the target band at the same time that unemployment is sitting at around 4% or even just a bit below.
Number 3, but how many times could the Reserve Bank of Australia cut this year? Here's Catherine again.
We haven't changed our view on how many cuts there will be in this cycle. We think there will still only be 2 25 basis point rate cuts, one in February and then an extended pause until the next one in August 2025. Now, we've been thinking that this is going to be quite a shallow easing cycle for quite some time now, and the ongoing resilience in the labour market really reinforces the likely shallowness of this cycle. So we think the cuts will be more about the RBA cautiously dialing back the restrictiveness of policy rather than February being the start of an aggressive rate cutting cycle.
Number 4, Australian consumers are certainly hoping for earlier interest rate relief, with relatively disappointing retail sales reported last week for November. However, ANZ Australia economist Maddie Dunk has spotted a few quirks in the figures.
One of the things to keep in mind is that we are seeing these real shifts in seasonal patterns around when people choose to spend money at the end of the year. And we have seen over the last couple of years that Black Friday has become more and more important. So people are spending more more in November and spending a bit less than they used to in December. And the ABS tries to adjust for that with what they call the seasonal factor. And what we've seen is that because this is a relatively new phenomenon, the seasonal factor is still being revised.
Number 5. Maddie says one standout area in the Australian retail sales figures for November was around dining and takeaway spending, which actually rose 1.5% for the month.
Because if you think about Black Friday, it's not really related in any way to dining and takeaway and those hospitality establishments. And over the last couple of months, there has been some upward momentum in that dining and takeaway category. So we've seen 4 consecutive monthly rises. There does suggest that people are getting back out and going out and spending a bit of money, maybe because they have had that boost to their household disposable incomes from the Stage 3 tax cuts.
Maddie Dunk there. Now, in our first deep dive interview of the year, ANZ's Chief Economist for Greater China, Raymond Yeung, explains why China is set to report growth in 2024 of 4.95%, almost hitting the government's 5% target, thanks to a range of stimulus measures at the end of the year, including incentives to buy new cars.
The December numbers, expand or rose by a double-digit rate, comes from the car sales, and apparently some of the government support to the EV sector and encourage the replacement of old car to new cars to bear fruit, and car sales have improved. The overall backdrop is that the government is supporting consumption, and there has been a policy, they call it the 2 new policy, to encourage both corporate and household to spend on new equipment and also new devices, including cars. So they call it 2 news policy. So we believe this type of supportive measures will continue, extended to the first quarter, or even perhaps will be a very regular consumption supportive measure in 2025 as well. So this improvement in car sales is, at least from the headline, is very encouraging. Now, of course, that this sector is pretty capital intensive. How much the car sales is able to drive the overall economic growth, to reduce the unemployment rate remain questionable, but at least it's an indicator of consumption.
And tell us about inflation in December in China.
I think the Chinese December's CPI is almost close to 0% and there's no inflation in the consumer sector at all. And the PPI, the Producer Price Index, is basically my preferred gauge of Chinese business cycle and economic cycles, remains negative, contract 2.3%. And it is already in the contractionary zone for 2 years plus 1 quarter. So we are talking about 27 months of negative PPI. And that tells us that China is definitely in still path of a deflationary track. And we have seen no signs of improvement in producer price, perhaps partly because of the overall economic downturn with the excess of demand, with overcapacity. But at the same time, there's also an intensive competition of suppliers from both the manufacturing sector to the services sector. And even if you go to restaurants in China, it's super competitive, and one restaurant would want to beat the price against another restaurant, in the same shopping mall. So I think this is exactly what's actually happening. Economic downturn, that the consumer is pretty cautious in spending. So suppliers can only do that by price cut, and that's intensified competition. So it means that we see this deflationary scenario continues in China. That tells us that the economy is still operating with a negative output gap, and the policymaker need to react with that with interest rate cut.
Given all that, what's the outlook then for 2025?
I think for 2025 that we still see a very, very little inflationary pressure in China. On the consumer side, we would see somewhere between 0.5 to 1% CPI increase over the next few months at least, unless we see a significant improvement of the economy. And the PPI will remain negative, given the fact that we may see a slowdown of global markets that may hit commodity price as well, given the fact that if the US is not cutting interest rate to the extent of what we previously expect, and that could probably lead to a slowdown of the developed economy of the buyers from Chinese goods.
Raymond Yeung there. I'm Bernard Hickey. That was the first 5 and 5 with ANZ for 2025, here on Monday, January the 13th. Watch out tomorrow for a deeper dive look at the outlook for New Zealand's economy in 2025. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.